Mike Tedeschi, Wealth Management Advisor at Perspective Wealth Planning with this week's market breakdown video. If you like this content, please subscribe to our channel so you can see this on a weekly basis. This week, we're going to take a look at the four major U.S. indexes. We're going to take a look at some sentiment data. And in fact, that's where I want to start today. I want to actually talk about some sentiment data that we were talking about in last week's video. Now, one of the things that we really like to pay attention to in these videos is not just the technicals, but I also like to take a dive and take a look at how retail traders are positioned against institutions, as typically historically when we get very stretched apart between those two, the market tends to move in the opposite direction, at least for the short term. It doesn't mean it's a major turning point, but it does usually mean that sometime in the near future we will have a pullback if retail traders are extremely bullish while institutions are not. Last week, we talked about the put to call ratio out of the retail traders and how it was off the charts, out of control to the upside. Retail traders were as speculatively bullish as they have ever been in their history. And sure enough, I was putting together the video here. We had a huge fall that day, right? We pulled all the way back down. We had about an 8% move down in the S&P 500 when, again, retail traders were unbelievably bullish in terms of their option trading. Now, the really bizarre thing here is usually after you have a quick move like that or a big sell-off like that, well, it will actually change the sentiment data and kind of bring things more back in line, and then the market can continue to grind. In this particular instance, it didn't change the speculative nature of how retail traders were positioned. They're still extremely bullish at this moment of time. And what I really wanted to talk about today is what this could mean for us moving forward. Now, when we look at historical data points, we're obviously looking at the instances where something has happened in the past, and we are trying to infer what that essentially could mean for the future. The one major wild card that we have here, and we've really been in play for the last decade, is really what the Federal Reserve essentially is doing. And why did the market stop here? Well, there, of course, is that technical reason that we pulled right back to that level of support. In fact, we talked about that being a level of support because it was resistance, and then we ultimately made our breakout. So we pulled right back to that. So you could look at this as a breakout and a back test from a technical side of things. But the Federal Reserve came in, stepped in, and said they will buy individual corporate bonds at this point in time, which, of course, the market found extremely bullish, and subsequently we made a really sharp bounce off of it. But as soon as we saw any hint of weakness, the Fed stepped in and did something extremely dovish for the overall market. They have printed a ton of money here this year after we had this huge pullback. They are doing everything that they can to try to prop the market up, and it subsequently is causing valuations to be really far out of historical norms. And if the Fed is basically saying to all market participants, we've got your back, why would you want to fight the Fed? And that may be part of the reason why the retail speculative numbers are so far stretched past where they normally are, is because they are looking at the Fed as basically that safety net, that backdrop behind the market. And if things get tough or things start to look bad in the overall market, don't worry, the Fed will have our back. They'll print more money, they'll buy more bonds, maybe individual securities has been talked about, etc. So you have that safety net. And that could really change all of those historical data points that we have and we normally look at, because we have a completely different environment now with that central bank printing. That being said, we're still going to pay very close attention to technicals because human behavior doesn't change over the course of history. That's why charts from 100 years ago will show the same patterns as the charts that we see today. So let's look at the four major indexes from those technicals. And what we see, of course, and I pointed it out on the S&P 500, we ran up into resistance, we subsequently failed at resistance, and we pulled back down to support, where we subsequently have made our bounce. Now, if we're taking a look at this, we are really paying very close attention to a close over 3130 for a move back into this upper resistance. And if we were to break above that, we would be looking at that all-time high. And if we cannot get up over that 3130 zone, we would expect this to be tested once again, that 2960 zone. And the thing we always have to pay attention to, the more times support is tested or the more times resistance is tested, the higher likelihood that it will ultimately break. So bulls really don't want to see us continuing to bounce off of this lower end of support. They want to see us continue to push higher. And so those are the levels that we're paying very close attention to on the S&P 500. Now, the Nasdaq continues to be an absolute monster. It's above those February highs. It is basically right back up into those all-time highs. So from an upper resistance standpoint, we really just have the all-time highs as our resistance. When we look at our support, the key level that's really on this chart is that gap down from February. You also can see we have a lot of price action around that 9,400 zone. And on this pullback, we stayed above 9,400. So that's the downside level that we would essentially be watching there in on the Nasdaq. Now we come in here and we take a look at the Dow Jones. Right, we poked above that key 2,700 level, and this was the concerning thing from a technical standpoint. This looks like an island reversal, and we have a big gap up, a couple of bars of trading, and then a big gap back down. The reason they call it an island reversal is because these candles are off on their own island, and price subsequently has reversed. It's also happened right above that 2,700 level, which makes this a potential false breakout if we can't reclaim this price zone in a short period of time. Like on the S&P 500, we did pull right back to that major key support level. So you could also look at this as the breakout back test, and we could have ourselves pushing higher, or once again, if we were to break underneath this level, that would be where the concern is. Okay, if we look at where we stopped rising right here. So there is still this gap resistance there on the Dow. And so what happens here right around this 27,000 level is very, very important, and we're going to continue to watch this. Last but not least, we'll take a look in at the Russell. Now the Russell here, when we come and look at it, we had a push all the way up into that 1550 zone. That's ultimately where we failed, right? The key level that we were talking about and watching is all of these supports from the end of last year. It was also the area where we ultimately made our breakdown earlier this year, and that's that 1450. We pushed right up above it. We failed right there at it. We came back down, and just like on the S&P 500, we found support right basically at that last key support level. In this case, this 1350. So when we're looking at the Russell, we're really looking at the 50s. We're looking at 1350, 1450, and 1550 as our key levels. That middle line, that 1450, is really what the bulls want to see us get above. Now, I actually want to take a look at some data on the Russell after it had 3 days in a row of 2% moves higher. That has only happened a couple of times in history, and that's what this means. As we can see here, it's only happened 4 times in the last 20 years. And it has not necessarily been a great thing. If we take a look at the Russell, it's been up more than 2% a day for 3 straight days. We actually look at those risk to reward results here in the short term. It's not very good. We only had one positive. That was 98. The other 2 times that happened were one coming out of that 2009 bottom where we kind of pushed lower for the next month or two. We also happened right there in sort of those .com highs right there, right before we ultimately made that bigger roll down. So it's not something that happens very often. You would think, if you're thinking through it from a technical standpoint, 3 big thrust days higher of over 2% would be good for the long term. Again, this data set's pretty small, but every time this has happened, it has not happened necessarily at a good time in the market, and subsequently we have seen pretty negative returns in the Russell over the next couple of months. The next data set I wanted to take a look at in today's video was the S&P 500 after the Nasdaq was up over 1% for 3 straight days, all within 2% of 52-week highs, right? So big push out of the Nasdaq as well. It wasn't 2% every day. It averaged over 1% a day. But we wanted to see what that ultimately looked like. And the data set does look better than what we had for the Russell. There's also a lot more data points in there. You'll notice a year out, we're positive about 70% of the time. So not phenomenal, but if you take a look at the positive numbers here, there are some really big ones, 30% higher, 20% higher, 25% higher, etc. So the average upside there is actually 11% to the upside. The negative, of course, was that this did happen right towards the end of that late 90s run in the market, and subsequently that was a little bit of a concern. But it also happened right as we came out of that bottom there in the 80s, right there at the beginning of that run up in the beginning of the 90s. So, of course, when you're taking a look at this data set, right, this could be that next leg up, or if we have a more result like this, right, we could be kind of nearing that topping point. Again, just very interesting to take a look at the data. And again, if we look at this, we're positive over 50% of the time that this has happened every single time in history. So it is a better sign for the overall market than the 3 points that we looked at from the Russell. Last thing I wanted to take a look at here is the smart money, dumb money confidence indicator. And we take a look at this on a regular basis. And we're actually at a very interesting point here on this chart. Usually when the dumb money is up in confidence over 70%, the smart money is more towards that 30% or below, i.e. there's a large gap between them. And we can see that when we're up here. Look at where the institutional money is. It's way down here. And even when we go back here, we can see the institutional money's way here and going all the way back. Same type of thing, right? The spread is usually very large between the two. What we have right now is we've got that retail investor extremely bullish, and we have the institutional sitting right around that 50% mark. The spread between them isn't very large, and that is not normal. So what we really need to do is we need to pay attention to this over the next couple of weeks to see if we have the institutional money start to fall back down, or if we are at a point in time where both the retail traders and the institutional investors are closer to agreement than they usually are, which of course could have some very profound implications for price action moving forward. So we'll continue to take a look at this. As always, I hope you guys found this information useful. I'm always available if you want to reach out directly to me and talk markets, anything related to them. You can reach out at mtedeschi@perspectivewealthplanning.com, or you can pick up the phone and give us a call at 814-580-9881. I look forward to seeing you guys next week. Take care.